June 4th after the market close, and we start off looking at a chart of SPX. And what is this? All of these lines. Let me explain to you what that is. This is called Fibonacci. This is a tool that we use here often, and is a very helpful tool known as Fibonacci retracement. And it helps you determine how much the market has retraced from the previous lows and previous highs. It can be used up and down both ways. So what I've done here is on a 9-month chart, and I've taken the bottom of this market in 9 months, which was on October the 4th, and then we placed it here at high, which was April the 2nd. So that is like almost like a 6-month process here. 2 months, yeah, 6 months. And this is what the market has been able to do. From 1075 it was able to get to 1425 in a rally off that bear market which we had last summer, the terrible market that we had last year. So these are Fibonacci retracements. What it is telling us that at this peak, when we start declining here, we have now reached almost 30, we have retraced 38%. You can see that 38% here. That is that line right here at we have retraced. The rally which ensued here, the market advance, is now retraced almost 38%. The next stop on it is 1250, which is the 50%, and then after that is 61% retracement, which is around 1220, 1210. But what is really happening here, let me show you. There are a couple of things here. It's called confluence here, confluence, and this is the 200-day moving average, and then the retracement is at also 38.2, and the 200-day moving average sitting right here. These are several things that are happening here at the same time. The market was able to penetrate that 200-day on Friday with the miserable job report, and then today it went down further but pulled back up here. But this is a very non-convincing doji. It's not a it's a bottoming tail with a small head, but it's very non-convincing. I mean, it does not have a big shadow, big dip here, but a little bit, and it does not look like to me a capitulation in any way. The market meandered down and then pulled back up by the bulls, but it did not manage to close above that 200-day moving average. If we gap up tomorrow and go above that 200-day moving average, then maybe the recovery would be back and we have a correction here. From this top, which is right here, about 1412 to 1278, if you take that minus that, you have about a 10% correction, which is a healthy correction. If this was a bull market, we had some kind of a good correction here amount. More than, if you take this top, then you have more than 10% correction here. So this is what really is important to know, where the market is going. And I'm going to remove this, or we're going to go take a look at some other stuff here. Some other indexes which is notable here, NDX, and I'm going to run through these very quickly. NDX bounced off its 50-day 200-day moving average, which is a good thing, and you also have this bottoming tail and a little body here, but it's not a capitulation type of candle here. That is, I'm a little bit concerned. Also on RUT, R-U-T, which is here, is still it's a little bit more prominent capitulation here, and it has a longer wick. So all of these are showing, but it's way below its 200-day moving average, which is at 750 or 760 right now. And Dow Jones, which is DJI, is sitting here at the 12,000, I believe. Okay, and it does not have that capitulation, so I'm just concerned if we move up here tomorrow, we may be okay. Some of the good stocks, LQDT is one of the stock that has defied this market and is very bullish, and sitting here at the 60-day. It's 60 point is below, is just below, is and above its 50-day moving average. And another one, which is Apple, that has defied everything lately, was also down today, but is above its 21-day moving average.